when that's going on beneath the surface of the indices, you should be very concerned, less tolerant of risk in your portfolio, because we're starting to see there's so much margin in the equity markets. And when this goes, it could go fast. I'm not calling a top, I'm not calling a crash, but my experience tells me once the markets realize that we'll shift from the economy's fine to bad in a heartbeat, and then everyone will try to exit at the same time.
Joining me today, Ed Dowd. Ed, thank you very much for joining me. You just wrote something recently that I thought we need to talk about here. You mentioned how you think the private credit market, which is a topic we've been discussing endlessly here at Uredale University for reasons, if you didn't know, will be abundantly clear after this conversation. But you said the private credit market is the new junk market. And not just that it's new junk market, which is interesting in and of itself, but that it's the new junk market that's about to be stress tested. Can you go give us a sense of what your summation and what your thoughts are on that?
Yeah, my Substack, Ed Dowd Beyond the Narrative, I wrote a piece last week. And I wrote it with the financial layman in mind. It's only about 1,000 words, and I didn't want to do a deep nitty gritty technical dive that made people fall asleep. But basically, it is the new junk bond market, except it's opaque, illiquid, and about to be stress tested. And your audience needs to know, and I kind of discovered this in my research on private credit over the last 6 months. The private credit market has taken share from the junk bond market. And the junk bond market, it's a higher quality of credit now, the overall market, because the bad credits are hidden in the private credit market. And the riskier stuff is there. And it makes sense because you don't have to mark to market. Well, you mark to market your own books. There's tremendous amounts of leverage. They claim it's, matching permanent capital and all this nonsense. But the bottom line is, this is the new junk bond market, but it's like illiquid, and we don't know what's going on. It's not public. There's no public quote. We don't know what's going on in the market. You can't see, the spreads widening. The only thing you can track is the inflows, outflows, and the equity of some of these companies.
Yeah. So, I think it was that's the part that a lot of people have focused in on, or, people who are looking at the issue, I think correctly, is that it seems like all the junk in the junk market moved into private credit. So maybe it's a better term to say that private credit is actually the only junk market now, because the junk market itself is, I don't want to say it's cleaned up, it just kind of lost market share to the hedge funds. Is that what you kind of see too?
Yeah. And, people point to, the state of the economy and say, well, credit spreads are tight. Well, they're tight because the stuff is hidden. But if you look at the CCC stuff is starting to widen. And some of the fixed income folks like Jeff Gundlach and others are looking at the CCC saying, hey, we're starting to see it. And, the CCCs are widening. That means, the private credit funds are seeing deterioration in their portfolio. And look, when you have an asset that you can mark yourself, but then a month later, it's 100 cents on the dollar. And this happened in the BlackRock fund, whose head of that fund just got fired. There were a couple bonds in their portfolio, or loans in their portfolio, I should say. They're marked at 100 cents on the dollar, then a month later, zero. And so your audience can understand this. In the old days, if there was a credit that was deteriorating, you would see it in the public quote of the bond debt. It would start to go from 100 cents to 95 to 90 to 85 to 70. So, people knew something was going on. Now it's just, lights out. One day you wake up and you're told, oh yeah, we have a bond in your portfolio that went to zero. It was 100 last month. And that's, I think, why we're seeing a lot of these redemptions in the private credit markets. A lot of investors are starting to ask questions. What's going on here?
Is that kind of recency? That's a lot of the counter bargaining and pushback that you get from people, is that, okay, we hear what you're saying, and yes, maybe there's a couple bad loans here or there, but it can't be that endemic, because otherwise, we got a lot of smart people on Wall Street, a lot of smart portfolio managers. There's no way they would have missed all of these signals, right? There's no possible way we could have that level of recency bias where people would say, okay, if there was trouble in the marketplace, then we would be seeing it all over the place. It wouldn't just be concentrated in these portfolios where we have to take the word for it from outsiders who don't really know what's going on. That's a typical industry pushback, right? You guys have no clue what you're talking about. We're on the inside. We sell the portfolio details, and you don't have any, you don't have the information and insight that we have. And so it feeds this kind of information asymmetry where people get thinking that, okay, nothing bad, we haven't had another Lehman Brothers. We haven't had a complete blow up. So therefore, this has to be such a big deal about nothing.
Well, I look at the whole piece of the puzzle, and if private credit flows are now going the wrong way, that's going to have quietly behind the scenes, it's going to seize up credit elsewhere. Credit is the lifeblood of the economy, and you've been around a long time, that once there's a problem in one sector, it starts to spread. And so
subprime is never contained.
Yeah, no. So what private credit, though it's dark, it'll affect other areas. And I wrote this in my article. It'll affect consumer loans. It'll affect commercial and industrial loans and real estate loans. So, the banks, JP Morgan already told you they're scouring their private credit books and reducing credit lines. So that has a knock-on effect. So if the marginal, and in our U.S. economy report we put out at the beginning of this year, we noted that in 24 and 25, the marginal credit of the country was private credit and private equity, because the non-depository financial institutions, the banks, the commercial banks, were lending money to these guys. That's where all the credit that was created came from. So if the marginal credit engine of the economy is stalled, that's not good. So we're going to see knock-on effects.
Yes, and you mentioned in the article too, something, PIMCO just came out with a report that said, look, we think we're starting to see the credit loss cycle shift, which is really the overall credit cycle. We've been on the upswing where everybody's happy, nobody cares, losses are low, default rates are low because, everything just kind of churns along. And then all of a sudden you get the credit cycle shift where losses start to show up, and it takes a little bit of time before it becomes a bigger deal. But I think, I think what a lot of people are looking for, and maybe you can help you actually can help shed light on this, some of the signs that we should be looking for something like if PIMCO's correct. If PIMCO's right that we're going to start seeing a credit loss cycle pop up, which would be pretty much a game changer, give us kind of some things that we maybe could look for where we see that. Because you're right, this is opaque. It's we don't have information. We can't look into these portfolios, and they sure as hell aren't sharing much information what they actually own. So, what are some of the things that we can look for that maybe aligns with what PIMCO is saying, or maybe refutes what PIMCO is saying?
Well, we can look at, even though the junk buying market is higher quality, if spreads in the higher quality stuff start to widen, that's a warning sign that credit is freezing. The triple C stuff continues to widen. You can also watch short-term interest rates. I believe the T-bill market leads the Fed. And if we start to see a mysterious, plunge in 3-month T-bill rates ahead of the Fed, something's going on in the credit markets that's not kosher. And that means the Fed's going to probably end up lowering interest rates, which I think they're going to end up doing anyway sometime in the next 6 months. Yeah. So that's what we watch. And watch the equity markets. I'm watching the dollar. I think the dollar put it in a very important low in January. And I think we're going to see the dollar continue to try to trend higher. I think there's a dollar shortage going on globally. And that also is not good for credit because, that the lifeblood of the global economy is dollars, and they need to be lots of them to keep the credit spigot flowing. And the dollar seems to I'm looking at the technicals. It looks like it wants to go up.
Yeah, I agree with you. I think there's a lot of reasons for that. And the other thing too is the downside here. I people have this misconception that we're talking about, the end of the or a 2008 replay or something like that.